So now we start with capital budgeting. So capital and budgeting. First of all, to start a business, do we require capital? Well, it's an obvious answer, right? We do require capital. But does this capital come free? Of course not. This capital does have some cost. Now, what do you think is a much bigger problem? Getting or arranging capital is a much bigger problem, or choosing between the opportunities is a much bigger problem? Well, some would say that, I have a lot of ideas, but I don't have capital. And others would say that we have enough capital, but we don't know where to put the money. So the problems can range from any things, from either having capital or having ideas. But the world does have a lot of capital, especially institutional investors do have enough capital. The most common problem that most of the investors do face is not just having capital, but where to exactly deploy this capital, because you have so many choices. You have variety of projects or variety of opportunities where you have to put the money. So between these opportunities, how do I rationalize or how do I select which is best for me, which is best for the investors? So the conclusion will be that which of the projects will give the maximum value to your shareholders? Well, that's the project that we'll be choosing up. But what are the various tools available to evaluate between various opportunities and conclude which one is the best? That's what we are going to see in this topic of capital budgeting. So let's start with that. First, let's understand what is the process of capital budgeting. So a company's finance is handled by let's say a position called CFO. What is CFO? Full form of CFO?
Chief Financial Officer.
Chief Financial Officer. What is his or her broader goal? Is it only about arranging funds? No. It's also about deploying the funds in the best possible manner so that the company gets the best returns. So a CFO's job starts from sourcing the funds to efficiently allocating them, right? So how does the process begin? First, the capital budgeting, the way you optimize your capital in the manner that you get the best returns, that's what is very important here. So it is one of the biggest responsibility of the financial managers that they identify relevant opportunities, and based on that, they select a project. So the capital budgeting process has 4 steps. The first is that you should have an idea where you want to deploy the money, whether you want to increase your existing business, whether you want to get into the new business, whether you want to reduce the cost, or basically you need to have some objective or some idea which you are willing to go ahead with. Then for that particular idea, let's say you want to get into new line of business. Markets are changing, markets are so dynamic that you want to get into a new business. So what are the proposals available to you? How do you want to execute the business? So first you should have an idea, then you should have variety of proposals, and in between all these proposals you'll have different outflows required, and you may have different types of inflows. So not all projects or not all proposals are same, so you will have to analyze each proposal, and then you will have to plan, you will have to budget all the proposals. Once you shortlist a particular project, you will have to ensure that the estimations that you had before putting your money in the project, you'll have to have some estimation of how much you will make, right? So whether the plan is executing properly, whether your estimations are whether the actual numbers are as per the estimations. So that is after the planning. After the planning comes the monitoring and post auditing part. So first, there should be generation of an idea. The second, there should be analyzing of various proposals. You shortlist one of those proposals, and then you start planning the entire budget and entire capital budget or the entire project execution. Once you do that, then your job is not done. Then you have to continuously monitor it. And after everything is done, after the project is done, you do post project auditing. So when everything is done, you do the audit to ensure that your estimation is it close enough to the actuals or not. If not, then there is very big error that, or very big issue that you must have created during estimating the projects. So all those differences that are there between your estimation and actual numbers, you should have reasons for that. That is the capital budgeting process. 4 steps: idea, proposals, planning for that particular proposal, executing it, and then monitoring and post auditing. These are the 4 steps. Clear? But what are the different types of projects that you would come across? The different types of projects. There are a variety of projects that a company takes. The first one is the replacement project. What is a replacement project? The name itself has a meaning. Here you're deciding between
to to replace it or to buy it, or the assets actually.
Correct. So let's say you already have a machinery and it is already old enough. When the machine is new, it is at its best efficiency. It gives you the maximum value, maximum number of units. But as and when the life of the machine, goes down, it starts depreciating heavily, and it requires a lot of cost to run it. There's high maintenance cost, and there's not as efficiency as it was initially. So you always have the dilemma whether I should wait for the machine to become obsolete, or should I replace it now with a newer machine. Correct? So replacement is a situation where you are comparing between, should I replace or should I continue with the old machine? Those are replacement sort of projects. Here you are always comparing between continuing with the existing one or starting or replacing that with the new one. That's replacement related projects. Correct? Then you have expansion projects. Expansion projects are basically projects where, let's say you already have a capacity of a cement plant. You are already you're already producing, let's say, around 1,000 metric tons of cement. Now you want to increase the capacity twofold or threefold. So will that expansion really help me? Should I do the expansion or not? Should I do the expansion at the existing plant, or should I open up a new plant somewhere else? Basically, should I increase my capacity of based on the estimation of revenue that I see in the future? Should I expand or not? Those are the expansion projects, correct? But remember, compared to replacement projects, expansion projects are more uncertain. Why is that so? Because you are estimating future revenues, and based on that, you are expanding now. Many airline companies, they estimated in 2003, 4, and 5 that there will be huge demand because the markets were surging, and especially when they entered in 2007, markets were at its peak. The global market was booming. So they ordered huge amount of planes, Airbus and Boeing aircrafts from, Airbus and Boeing. And these orders take, it takes delivery of 3 to 5 years to come to your doorstep. So they did give the huge orders in 2007. And what happened after that? There was a financial crisis in 8-9. So when there was a matter of taking the delivery, many of them backed out, and they suffered huge losses because they had booked at peak, and they had expected that there will be, surge in the global travel, which fell down to a good extent after 2007. However, it recovered later back. But right now also, just imagine companies who must have done huge expansion by, ordering Boeing or Airbus planes in 2018-19. They must be at a huge, financial mess right now, isn't it? Why? Because there's almost 95% drop in the air travel. Are you getting me? So
No demand.
no demand. So these are the points where you have to be more certain when you are going for expansion projects. You have to be more certain, or you are taking perhaps more risk when you are going in an altogether new business. So when you're starting a new business from your existing business, it's an altogether a new, market. You are not having, your company may not have an experience of dealing with such markets. So there more careful analysis is done. These are more complex projects. For example, India's oil giant Reliance Industry, right? The biggest refiner in the world, by the way. They have the biggest refinery in the world in Jamnagar, Gujarat. And they were known for that or their oil and gas industry, but the day they decided to get into the telecom sector or retail sector, it was more like, getting into the new markets. At that time, it would have been probably, they must have done a lot of analysis before getting into such business. However, now you can see they getting the fruits of it, and that business is much better than the existing business and has more value in the future as well. But getting into the new territory is always more riskier, and you require more analysis. Our topic of capital budgeting here may not cover that detailed analysis here, but they're just trying to tell you that how projects can turn very complex. Clear, everyone? Then there are some mandatory projects also. Some mandatory projects where you have to do because of the regulations or because of the safety or environment related issues. For example, if I am a chemical company, there are various regulations which tells me that I can't just throw away the waste, the hazardous waste in the river, or just dispose it off anyhow. There has to be, the regulations tells me that I have to have a process in order to in order to deal with this waste, which is altogether a another project. Correct? It's not a waste that you can just load it on the truck and throw it anywhere. It doesn't happen that way, especially when you're dealing with hazardous chemicals and all. So these are the mandatory projects that I may have to take, and you will have to in these are not for profits. They are for some constraints, or they are not going to generate any revenue, substantial revenue or anything, but they are just something that you have to do it because of some compulsion. Correct? So you have to a lot of times take these mandatory projects also. Clear, everyone? Even if they are not profitable, you may have to do it. Got it?
Sir.
And then, before the start of a huge project, many companies start initially some pet projects, some small projects. Like they can start up with a R&D, research and development center, and they may invest heavily in it. For example, during the time of pandemic, many companies got into the researching for vaccination. Now, not all may find success in it, but everyone must have deployed huge amount of their resources in order to get the right formula for the drug. So these are pet projects. They are very risky. If successful, they are brilliant. If your vaccine is having good accuracy and good efficiency, then that will definitely be a success story. Otherwise, you lose all your money if the vaccine is not as that great. So these are pet projects where there is a lot of R&D going into it. So these are more complex projects. They are perhaps not going to be evaluated in our session here. They're not something that can be evaluated just on a spreadsheet. You require more detailed analysis in such projects. Got it, everyone? Clear?
Yes, sir.
Okay. Now, let us focus on some principles before we get into the capital budgeting. First of all, let's say I'm going to start a project. I'm going to start a construction of bridge. But before doing the construction of the bridge, I want to run a feasibility test, whether we are prepared for constructing the bridge or not, whether getting into such business is viable or not. So these are the surveys and analysis that I will conduct before starting the project. Now, all those costs which are not directly related to the project, they don't affect your decision after the project starts. So once your project starts, then you should consider all the costs related to the project. But the costs which are already incurred, these before the start of the project, right? And they don't affect the decision of the project. For example, I don't mean that, the research I was anyways going to do it. Whether I take the project or not, I have to conduct the research. So the decision that you're going to take, right, whether to do the project or not, but before that, you have to incur some costs, like the marketing or research cost. These costs are called sunk cost, and sunk costs are not to be considered in the capital budgeting decision. So all the costs before you arrive to the decision of starting the project, all the costs are like marketing research costs. They are called sunk cost and they should not be included in your project evaluation. Is that clear, everyone? Correct. But there are some costs which you should include even if you don't do it. For example, I already have a vacant property and I normally lease out that property and I earn some rent. But now, since that property is my own property, I start doing the manufacturing at that property, right? And I produce goods and try and sell it. But I don't pay rent. I don't have to pay rent to myself. Still, should I consider that rent as one of my costs, even if I don't pay it to myself? Should I consider that?
Yes, sir.
Yes, because it's an opportunity cost.
Opportunity.
So opportunity costs are to be considered whether paid or not. That is second important point. And the third important point is that you always should look at incremental cash flow in order to arrive at a decision. For example, when you're doing replacement projects, you are comparing the existing machine and the new machine. So let's say for the next 5 years, if I run the new machine, what will be my costs? And if I run the old machine, what will be my costs? So I don't have to do it twice. I can just take the difference between both, the net between running the new machine and the old machine. So incremental cash flow is a technique that we use in project financing or capital budgeting, where we just take the net cash flow instead of taking it twice, cash flow of company A and company B, or project A and project B. We just take the net cash flow. So incremental cash flow is the cash realized on account of a decision, cash flow with decision less the cash flow without the decision. So if I choose A, what will be my cash flow? Minus if I don't choose A, I choose B, what will be my cash flow? So you just take the net difference between the two identical projects, and that is called incremental evaluation or incremental cash flow evaluation. Clear? So you don't have to repeat twice. You can just take the difference and continue with the project evaluation. Got it?
Yes, sir.
And then there is one thing that you need to understand in project, like when you take opportunity cost, for example, what I told you about the rent, there's also something that you may lose because of taking one project compared to another. That's called cannibalization. Cannibalization is a process, especially negative cannibalization is a process where you launch a product and that affects your existing line of products. Your existing line of products. Now I've shown you here two cars. These two cars, do they look similar or not? Do they look similar? If you see, they are almost same. This car is, by the way, Nissan Petrol, one of the most famous cars in the desert. And the prodigy of that is another car, which is that car. This is one is Nissan Petrol and another is
Infinity name.
Infinity QX.
Yes.
QX 380, I think. Now they are almost same from outside and from within. And by the way, Infinity is one of the companies of Nissan, correct? Now, if Nissan wants to sell more of its car, and if they sell Infinity at a lower price, people will choose Infinity. So Nissan, Nissan can say that, I have launched Infinity, but that is taking my existing sales, isn't it? So your revenue may increase, but at the cost of your another product. Overall, your revenue may increase, but at the cost of another product. For example, in India, we see there's a huge demand for Kia motors, correct?
Yes.
Kia Seltos, I think.
Yes, sir.
And that has taken away the business from its sister company, Creta.
Creta.
And both are the same. It's a sister company. Kia is the company of Hyundai. Got my point? So the same we have seen in the past with Thumbs Up and Coca-Cola. Thumbs Up and Coca-Cola is a very classic situation that Thumbs Up is giving huge competition to Coca-Cola in India. However, it's its own brand. Are you getting it? So that is called negative cannibalization. And negative cannibalization is a very big issue, and you should consider that issue, especially when you are investing in when you're evaluating projects, where you have to ensure that not that one of your projects should not affect the other projects. Okay, so if that is affecting, you should consider those costs also. So I will just share you
What is positive cannibalism?
that one of your product helps the other product. I will show you. So can you see my screen here?
Yes, the
Yeah.
live.
This is an interesting article which I've added the link here. How Thumbs Up actually took away the market from Coca-Cola. Even after Coca-Cola acquiring Thumbs Up and spending huge amount, it could not finish the brand. In fact, Thumbs Up is challenging Coca-Cola. So one product of Coca-Cola is challenging, Thumbs Up is challenging its Coca-Cola, and that's what I'm saying. So Coca-Cola is being challenged by its own product. Now it's in such a dilemma that it can't even shut down Thumbs Up, because that is more in demand than the Coca-Cola's original product. This was the issue in the past. Now these days people don't, of course, go for soft drinks, but Thumbs Up had taken away the market from Coca-Cola, and Coca-Cola could not do anything about its own product. That's what I think is happening with Creta also, that they probably are going to face huge issues with their own product. That's going to happen. Yeah, you were saying something.
Positive cannibalism.
Okay, positive cannibalization. Yeah, positive cannibalization is when your one product helps you with the another product. For example, uh, you can say the like Tata Motors. They have products which are, let's say, if Tata Motors takes over, also does manufacturing of tires. So it's one product will, the more and more sales it does with respect to cars, the more its tire business will also flourish. Got it? So that's, one product helps the revenue for other products. So it's just not selling a car, it's also helping you with selling the other
Or
products.
byproducts.
This is very, very common in the financial sector, by the way. For example, India's largest bank, State Bank of India, or HDFC or ICICI, these banks, they already have their retail branches all over India, correct?
Yes.
Now, let's say there are two mutual funds in India. Let's compare that. Two mutual funds. One is BlackRock, which only does mutual fund in India. And then you have State Bank of India, which does everything, banking, insurance, and everything, mutual funds. Now, if BlackRock wants to open a branch in one of the outskirts of a village in India, it will be too costly for it, right? It will be too costly for it, isn't it?
Yes, sir.
And it doesn't even know whether it will get enough revenue or not. But see, State Bank of India already has a branch in such a village, and it just has to appoint a person to sell the mutual funds. Correct? So their existing pipeline helps them push another product. They don't have to put up a new infrastructure altogether. Got it?
Yes, sir.
So therefore, if you always see in countries like India, the top mutual fund companies are always banks, because they don't suffer loss. They don't have to put an altogether new infrastructure. They already have the resources and they have the branches there. They just have to add the product. And these days, banks are telling their existing employees who are doing probably the operational job of collecting the cash or punching the data, bank has told everyone to start selling mutual funds and insurance. So now they are not even hiring specialists to do that. They are telling the existing branch people to sell the products. So these people who are taking and collecting the checks, now they are also advising you that why don't you buy a mutual fund? Why don't you buy an insurance? Why don't you buy a credit card? Have you observed something like this?
Yes, sir.
So these same people are now recommending you, because the bank's infrastructure is such that they don't have to put a new resource. They don't want to put a new resource, and they can do the same business without incurring the cost. That's positive cannibalization. Clear?
Yes, sir.
Right? So these things we have to consider when we do project evaluation. Now, when you evaluate a project, right now, initially, you will have to invest some capital, correct? That's called a cash outflow, which is a negative cash flow, correct? Because it's an outflow. And in the later years, you can expect the cash inflows. Am I correct? Now, a conventional project or a conventional cash flow is a project where initially you just have to do one outflow and then you just have inflows. This is called a conventional cash flows, right? This is only for the purpose of evaluation in the syllabus. In the syllabus, mostly you will see which type of cash flows? Conventional cash flows, where you have one outflow now, CF0 negative, and then you have C01, C02 positives. So you can easily calculate NPV or IRR, which we will see now. However, in real life, is it that you just have outflow now, you won't have outflow in the future? In real life, you will have outflow in the future also, right? Not necessarily you'll always have inflows. Got it? So real life project is very much like project B, where right now you have a huge outflow, then inflow, and then outflow, and then inflow. It's a zigzag. Are you getting my point?
Yes.
These types of cash flows are called unconventional cash
Non-conventional.
or non-conventional cash flows. Clear? So a conventional cash flow has one cash outflow now and then only cash inflows, but a non-conventional cash flow, unconventional cash flows has cash outflow now and maybe later also. Clear? Of course, it will be easier for us to calculate when you have conventional cash flows, and most of the problems that you will face in exams are all about conventional cash flows. Clear? Now, before we get into the calculation of various before we try to understand various techniques to evaluate the projects, let us understand some very, very important principles which are applicable in project financing. First is that the projects are evaluated not on the basis of profit, but on the basis of cash flow. You know why? Which is more reliable, cash flows or net income?
Cash flow.
Well, you know, cash flows are more reliable, right? And you also take cash flows after tax, not before tax. Okay. You have to adjust the taxes also. So very important principle. Your decisions are based on not
Cash
net
flows.
income, but on cash flow basis. And you have to also consider them on the post-tax basis. Clear? We also discussed that you have to take into consideration the opportunity cost. So if there is something that you haven't paid, but you would have paid, you have to take that into consideration. And second, the timing is very important because we are considering everything from the time value of money. Clear? And how are we going to consider time value of money? Because we are going to discount everything to the present value. Are you getting it? We are going to discount everything to the present value. And what are we going to use to discount them? What is that we are going to use to discount it? Well, we've done that in reading number 33.
You mean the discounting rate?
The discounting rate, which is the cost of capital.
Cost.
And cost of capital covers your cost of debt and equity both, right?
Yes.
So if it already covers the cost of debt and equity, then you don't have to separately consider the financing cost in your budget. You don't have to deduct the interest in your capital budgeting. Why? Because that is already considered when you discount them in the WACC calculation. Clear? Everyone? So when you're evaluating a project, do you take interest into consideration or dividend into consideration? No, because that is already covered when you are discounting them by WACC. Are you getting me, everyone?
Yes, sir.
So financing costs are taken or ignored?
Ignored.
Financing costs are ignored. Clear, everyone? Right? This is the reason why we first do cost of capital and then we come to capital budgeting. So what are the types of projects? Well, two types of projects, independent and mutually exclusive. For this, let me give you an example. Let's say there are two projects, A and B. In both the projects, you may have to give a cash outflow of $100 million. And in return, you get, let's say, NPV. I'll take NPV now, sorry. I'll take NPV now. Let's say NPV here you'll get $20 million and here you get $15 million. Which project will you choose? A or B? Simple. Which one will you choose? Definitely the one which gives you higher NPV, isn't it?
Yes, sir.
So you will choose A.
A.
But what's wrong with B? B is also giving you $15 million. Why not? Well, if you have enough capital, why not choose B also? Any project which is giving you positive NPV, you will choose them, isn't it? If you have enough capital. So if you have unlimited capital, the outcome is that invest in all the projects which are profitable or which gives you positive NPV.
Positive NPV.
But if you have limited capital or if you have limited resources, let's say you have only $100 million, then you will have to choose between A and B. So whenever there is a situation whether you have to choose either this or that, those are called mutually exclusive projects. You can't take both. You can take either of the projects. Clear? But independent projects are where you can just simply evaluate the projects based on the profitability and take all of them if they are profitable. Why? Because the projects are not related to each other. Each project is evaluated individually. Clear, everyone? So
Yes,
why in independent projects I will take all the projects?
capital, but unlimited funds.
If I have unlimited funds. Clear? But in mutual exclusive, I may have some constraint on resources. So I will have to budgetize. I will have to rationalize. That's called capital rationing. And in that case, the funds which are the project which is the best, I will have to choose. That's called capital rationing. Clear, everyone? So unlimited funds, you can just put in all profitable projects, but we normally assume the situation that no one has unlimited funds. So we will always have to we'll always have to rationalize. And rationalizing means choosing the project which is the best for your shareholders. Clear, everyone?
Yes.
However, there can be a situation where you may come across project sequencing. What is project sequencing? Project sequencing is a situation where you may have to take the project in stages. You may have to take the projects in order. You can't jump the order. For example, if I have to, if I have to get into the project of oil well, I will first have to see whether I get oil at, let's say, 1000 meter below the ground. Okay. That's first project. If I do get oil or if I don't get oil, based on that, my decision will be whether I should dig more deeper. So it happens in stages like this. So first I'll dig for 100 meters or 1000 meters, and then I'll go for stage 2 and stage 3. So you have to take the projects in order, because your next order depends on what is your previous outcome of the order. Based on that, you may take the next decisions. So many mining companies and oil and gas companies, they take the projects stages wise. They don't take an entire project. And you can do that in any business. For example, you have milestones that if you meet this milestone, then we reach out to the next project. Then we reach out to the next project. This is how people take projects at times in sequence rather than taking the entire project. Clear? Everyone?
Yes, sir.
Okay. So let's focus with the techniques of capital budgeting. After understanding the basics of capital budgeting, the techniques that we are going to use are payback period and discounted payback period, NPV and profitability index, and IRR. So these are the major techniques that we are going to focus on. And then we will discuss on the most important topics of NPV and IRR in detail. So let's focus on payback period. What does the name suggest you? Payback period. The name itself has the meaning, by the way.
Time frame.
Sorry?
That kind of a time frame, like.
Very good. Time frame. Yes. Time frame means it will tell you in how much duration, the initial investment that you have put in the project. Let's say you put $100 million. In how many number of years you will get this money back from the cash inflows? In how many number of years you will get this money back from the cash inflows? For example, let's take this example, which we just discussed. -100 was your initial outflow. So how much did you spend in the budget, in the project?
100.
100, correct? That's -100. Now, in the first year, you're going to get 25. In the first year, you're going to get 25. So 25 in the first. In the second year, you're going to get 50. So cumulative, how much amount am I getting? 25 plus
75.
75. And in the third year, you make 75 again. So 75 plus 75, 150. So can I say I get my initial $100 back somewhere between 2 and 3 years?
Yes.
So 2 plus in 2 years, how much money do I get back? 75.
75.
Which is remaining?
25.
25, and that divided by the cash flow in that year, which is 75. So in the entire year, you get 75. So how much do you get 25 in 1/3?
4 months.
In 1/3 of there, that is 2.33 years, I can say, which is correct. 2 years and 4 months, you can say. So 2.33 years is the time that it will require for me to
Get my money back.
get my initial investment back. But there's a problem here. What did I not consider? Well, I did not consider the time value of money. Isn't that important? I
Yes,
just
sir.
consider the absolute values. So the amount that I'm going to get in the future, I should consider the time value of money. And when I consider the time value of money, I discount the cash inflows to get it to the present value. That is called discounted payback period. What you just saw is called payback period. And now I will discount the cash flows. So I've already discounted the cash flow at a given rate of 9%. I've got these values. Instead of 25, I discount them for 1 year at 9%. 50 will be discounted for 2 years, which will give you 42. And 75 will be discounted for 3 years, which will give you 57.91. How to discount that? You can just simply take 75 divided by 1.09 raised to 3. So this is how I got discounted cash flows. And now I'm going to take the present value of these discounted cash flows. So this is going to be 22.94. And then you add 22.94 plus 42.08, you get 65.02. And then you add 57.91 to this, you get 122.93. Clear, everyone? This is the cumulative discounted value. So now if I calculate the payback period using the discounting rate, it is called discounted payback period. But before I calculate, tell me one thing, will it take now more time or less time compared to the payback?
More time.
More time, because the value of the cash flow is reduced. So it will take more time. So now also it is somewhere between second and third year. So I will put 2 plus till the second year. What is my present value? 65.02. So 100 minus 65.02. I still require how much? 34.98. Divide by the present value in that year. The present value in that year, in the third year, is 57.91. So I will do 57.91. Correct? That will give me 2.60 years. Everyone. So what change did I do from payback to discounted payback? What is one change? What is the one problem of payback that I included in the discounted payback?
Time value of money.
The time value of money. Correct? But still there is one problem which is not resolved, whether in payback or discounted payback. For that, let me show you an example here. Let's say there are two projects A and project B. And then let's focus on the cash flow in year, let's say 0. In both the projects, you put 100. Okay. Now, in year 1, let's say year 2, year 3, year 4, and year 5. Quickly, I'll just add the cash flows 2, 3, 4, 5. Let's say here you get 50 and here you get 50. And then you get 5 and you get 100 and then you get 200. Okay. In this project, you get 90 year, 10 year, then you get 2, 5, and 10. Okay. Can you tell me, just ignore the discounting factor. Can you tell me what is the payback period required? In how many time period does your money come back in project A? I've made it very simple so that you can easily calculate.
Years.
How many years?
2 years.
2 years. Isn't it simple? 2 years. So here it takes 2 years. And what if I make it more simple, where in the first year itself I have taken 100. So in project B, it takes 1 year, right?
Yes.
Which one will you select? The one which has higher payback or the one which has lower payback?
Lower payback.
Lower payback, right? Because that's the best one. So assuming it's a mutually exclusive project, you may choose project B. But while doing this, we did a mistake, is that we just focus on initial investment, but we ignore all the cash flows after that, don't we?
Yes.
That may change our decision substantially. We completely ignore all the cash flows after that. That is the problem. It does not, this technique of payback and discounting payback does not completely evaluate the project. It ignores all the cash flows after the recovery of initial investment. That's a problem with both of them. Clear, everyone? So now I get questions that why do we calculate it? I'll come to that point. But before that, what is payback period? It's going to tell me an answer in number of years it takes for my initial investment to recover. Clear? But what are the drawbacks? It does not take time value of money, and it ignores the cash flows beyond the payback period. Correct?
Yes.
However, when I take discounted payback period, I cover this one problem, which is the time value. Because of this, the discounted payback period is always going to be higher than the payback period. Clear? Higher or lower?
Higher.
Higher. Again, the advantage is that it takes time value of money into consideration. But again, the disadvantage is that even this discounted payback technique does not take the cash flows beyond the initial investment recovery. So why do we take this into consideration? Why do we take that into consideration?
Liquidity purpose?
Sorry?
For the liquidity purpose?
Yes. Let's say I am your CFO and you are my manager. Okay. You have come up with 2 proposals to me, project A and project B. And you tell me that, sir, project A is wonderful. We should do project A. Will you give me capital for project A? I will say that, see, we just have capital for 1 year. We don't have capital for more than 1 year. So do one thing, shortlist only those projects which are profitable and which will give us back money in 1 year. So then, even if you have projects which are better, you may not be able to take them because you have got a capital constraint from your top management. You may have to repay the debt within 1 year. That can be an issue. So this technique of payback period or discounted payback period, I'll use the same word, payback period, may not be the decision making which project to select, but is generally used as the starting point to filter out projects. For example, my management will tell me, Kunal, don't take projects which has payback more than 5 years. So I will ask my management why. So they will say that we have capital only for 5 years. We can't give you capital forever. So then I will go in my spreadsheet and see all the projects, even if they are profitable, but if they take more than 5 years, I'll skip them. I'll only filter all the projects which are within 5 years. And then from those remaining projects, then I can evaluate which one is better or not using other techniques. Got it? Clear? So why is this technique used? Firms may use this technique as not a decision-making technique, but the step 1 in the decision-making. Clear? Everyone? Make sense? Anyone? Any doubts here? Hello? Make sense, everyone? So payback and discounted payback, will I use them? First of all, do I want them to be higher or lower?
Lower.
Lower. But will you make an entire decision based on that? No, because it does not completely evaluate the project. However, as I said, that can become a starting point of your decision, that which project you should shortlist. So it's a very, very important tool used by management, as I said, not to take the decision, but step one in the decision making. Clear, everyone? Payback and discounted payback.
Yes, sir.
So in reality, the techniques that we used in selecting the projects, especially the mutual exclusive projects. See, in mutual exclusive, you have to select the projects, the best of all. The technique which we used is either NPV or IRR. So let's focus on NPV. Net present value is nothing but it is the difference between cash inflow and outflow in present value terms. So what is NPV, guys? NPV is nothing but NPV is PVCI, present value cash inflow, minus PVCO, that is present value of cash outflow. Present value of cash inflow minus outflow. What do you want to be more? Inflow or outflow? Well, definitely we want the inflow to be higher, correct? Everyone?
Yes, sir.
So if the present value of cash inflow is higher than the present value of cash outflow, we say the project has positive NPV, and therefore we will select such projects. So all the projects which have NPV above 0 should be accepted or rejected?
Accepted.
They should be accepted. And the projects which have NPV less than 0, you should reject them. And those which are 0, you should be indifferent about them. Clear, everyone? This is the situation when you have independent projects. When you have all independent projects, you will only take all those projects where the NPV is positive, and you will reject all the projects where the NPV is negative. However, when it's a mutually exclusive projects, you can't take all the positive NPV projects. You'll have to take only that project which gives you highest NPV, net present value. Why net? Because it's the difference between cash inflow and outflow. And why present value? Because you discount everything in the present value now. And the discounting rate that you're going to use here is your cost of capital, WACC. Clear, everyone? And how did we get WACC? We've seen that in the cost of capital topic. Clear, everyone?
Yes.
So let's evaluate mutually exclusive projects and see which one will be selected. So here I've given not PVP and NPV. Here we will calculate NPV and one more thing called PI. What is PI? I'll come to that. Profitability index. I have not discussed. If the discounting rate is 9%, let's calculate the NPV. First of all, NPV. What is the formula for NPV? I told
Inflow minus outflow.
present value cash inflow minus present value cash outflow. That's NPV. Okay. First, how do I get it? The discounting rate is 9%. What we will do, we will go in the which function, guys?
PV function.
Cash flow function, everyone. So let's go to the cash flow function and remember this numbers here. So let's go to the cash flow. Let me first show you all the numbers here. You have 100, that's your outflow, then 25, 50 and 75. 25, 50 and 75. So let's go that. By the way, we've discounted everything to the present value and we've already got that from here. If you remember, what is the present value of all?
Yes,
122.93, correct? So you are anyways going to get this, the present value of all cash inflows. Are you getting it? We discounted all when we did the total of it. If you want, you can check it, but that's going to give you 122.93. That's your cash inflow. And from that, if I subtract cash outflow of 100, what will be my answer?
Plus 22.9.
22.93. That's cash inflow minus outflow. Clear? Everyone?
Yes.
So let's solve it for project B. You have minus 1100, then 250, 600 and 750. 250, 600 and 750. So let's take this. So CF second clear. Your CF0 is 1100 negative. Enter. Clear? Then your C01 is, how much was it? How much was our C0? Let me check.
250.
250. Okay. Your C01 is 250. Enter. C02. C02 was 600 and then 750. So 600 and 750. So you can see my calculator, guys.
Yes.
So C02 will be 600 and sorry, C02 will be 600, enter, and then 750, C03, enter. Ensure that you don't have anything in C04, correct? And then your discounting rate we have taken here is 9%. So NPV 9%. When you press NPV, you get I, that is 9%. And when you press down arrow, you get NPV, you press compute, you get an answer of 213.50. Visible on my screen? Everyone? 213.90. That's my NPV, 213.90. Everyone clear?
Yes, sir.
50.
Yeah, 50, sorry. 213.50. Correct. So, which project will you select, A or B?
B.
You will select B because it gives you higher NPV. When it comes to mutually exclusive project, which project do we select? The one which gives you maximum value to your shareholders. But do you notice that for project B to select, you will have to put more money now?
Yes.
So what happens that many times NPV may not always give you a correct answer, even if it is most used and most reliable, it may not be feasible. It may not be feasible. For example, I will show you another example here. Let's say I have two projects, A and B, and both of them have PVCI and PVCO, and then based on that I get the NPV, correct? So let's say project A has PVCI of $110 million and PVCO of $100 million. So can I say its NPV is 10, right? But project B has PVCI of 30 and PVC of 20, and even its NPV is 10. Ideally, which one will you select? Well, based on NPV or indifferent, right? Correct. But even if I increase slightly here, let's say even if I increase project A's PVCI is 111 and here you get 11, still which one will you select now? As per the NPV rule, you will select project A, but is it feasible? Is it sensible
No.
to select project A?
No.
So this is where, why is not feasible? Because just to get $1 million extra, you will have to put
100 million.
you'll have to put 111, you'll have to put 100 million, whereas in project B you just have to put $20 million. Are you getting my point? So
Yes,
NPV is the best thing, but when two projects are not properly evaluated with respect to the NPV tool, we also go a step further and we see how much have we put in and how much did we get in, how much did we get from that project. And that's where we calculate a ratio called as profitability index, PI. PI is profitability index. Profitability index is a ratio of PVCI divided by PVCO. It's a ratio of cash inflow and outflow, everyone. So now, what is the PVCI in project A? Present value cash inflow?
11. 111.
See,
0.
present value cash inflow is going to be NPV plus outflow, right? If you see this equation, so it will be NPV plus PVCO, correct? So it's going to be 122.93. So if you just take 122.93 divide by 100, you will get 1.2293 here as an answer. Got it? Clear?
Yes.
And for project B, first of all, add 1100. So add 1100 to 213, 1100 to 213.5. So your PVCI is, in this case, I got 1313.5. Am I correct?
Yes.
And that divided by 1100, you get an answer of 1941. Am I correct?
Yes.
So what does this ratio tells you? This ratio tells me that for every $1 of outflow, cash outflow, PV, in present value terms, I get a cash inflow of 1.22 for project A. And for project B, I just get 1.19. So now you can properly tell which of the project is better, A or B.
A.
A is better. So same here, if I had calculate, let's say here PI, so here my PVC I divided by PVCO, this was 1.11, but in the other case, it would have been 1.30 divided by 20, it would be 1.5, correct?
Yes.
So this gives me a better outcome. Are you getting it? Everyone? Correct? So two things. NPV, what does it tell you? It tells you the value, the dollar amount that you get in present value in today's terms if you select a project. So which project will we select? The one with the highest NPV. But then why do we calculate the profitability index ratio? It is a ratio of PVCI divided by PVCO. Everyone. And PVCI is nothing but, it is nothing but NPV plus PVCO. Correct? So guys, tell me one thing. If your NPV is 0, can I say it means your PVCI and PVCO is same?
Yes.
So when PVCI and PVCO are same, your NPV is 0 and your PI, profitability index, is
0.
1.
1.
Why? Because they both are same. So the ratio will be 1.
1.
Got it? So when NPV is 0, PI equals to 1, your project is indifferent. But when NPV is positive, your PVCI, which is in the numerator, is higher. And therefore your PI will be greater than 1. Are you getting it, everyone?
Yes.
So NPV greater than 0, PI greater than 1. Should I accept the project? Yes. NPV less than 0, PI will be less than 1. Reject the project. Clear? Everyone? And between two projects, which one do you select? The one with highest NPV. But now when it comes to PI, which one will you select? The one with
Highest PI.
highest PI. Is that clear, everyone? Correct. Any questions, anyone, with NPV and PI? Both have different meaning, both have different purpose, but they help you make the decisions better. Clear?
Yes, sir.
So till now, I've connected NPV and PI both. If NPV is greater than 0, then your PI is definitely greater than 1. In both the case, except the project. And when NPV is less than 0, your PI is less than 1, reject the project. Everyone, right?
Yes.
Now, guys, I want you all to do with me again the calculation of NPV. So let's go to the calculator, guys. And here we had, by the way, calculated the NPV was 22.93 or 94. and your PI was 1.2293. Am I correct? This is what we did.
Yes.
Now I want you all to again go to the calculator and do one more thing there. Let's go back to the calculator, everyone. Okay. So my cash flows in the first project was 100. So I'll put 100 negative. First of all, I'll clear it. Second, CF second clear. CF second clear. Right? CF0, I'll put 100. Sorry. CF second clear. I would put CF 100 negative enter. Then I had C01, which was 25. Then C02, I had 50. And C03, I think we had 75, correct? 75, yes. Now here, there is one more function besides your NPV. If you notice here, this function IRR, are you getting it? Everyone?
Yes, sir.
If you press IRR and then press compute, it will give you a figure of 19.4377. 19.4377. Got it, everyone?
Yes.
Now, first, let me write down here the answer 19.4377 or 44 percentage. That's the internal rate of return. That's the compounding rate of return in percentage terms if I invest in this project. If I invest in this project. So, what is this project's timeline, by the way? How much will you invest today in the project?
100 million.
100 million. Let's say 0, 1, 2, and 3. Correct? So in the first year, you invest $100 million, then you get 25, then 50, and then 75. This is like calculating the IRR or I by Y. So the returns that you make from these investment in amount, it is NPV. NPV gives you the answer in dollar terms. But IRR tells you the answer in percentage. How much did you make in percentage terms? How much did you make in terms of compounded returns? That is 19.44. Good or bad?
Good.
Good. What are you comparing with? You have to compare it with your cost of capital, which is how much here?
9%.
9%. Guys, IRR is nothing. IRR is that rate. IRR is that rate which helps you achieve returns. So IRR is actually like I by Y in project financing, or let's say in bond valuation when you will do, it's like a YTM. So what IRR basically does is that IRR is the discounting rate. If I were to solve this manually, it tells me that 100 is equal to 25 plus 50 plus 75 discounted with a common rate. Let's say that rate is IRR. So I will discount with, for the first cash flow with 1 year, the second cash flow with 2 year, and the third cash flow with 3 year. So this 19.44% is the discounting rate, which will ensure that the present value of all this cash inflow is equal to
NPV.
is equal to the present value of all cash outflow. So guys, IRR, what is IRR? IRR is the rate at which
Cash inflows are discounted.
present value of cash inflow equals to the present value of cash outflow, guys. Therefore, can I say at IRR, PVCI equals to PVCO, which means NPV is 0 or PI equals to 1, isn't it? Am I correct, everyone?
Yes, sir.
So IRR means how much did you earn on the project. And cost of capital means how much you should earn on the project. What do you want? Do you want the IRR to be more or cost of capital to be more?
IRR.
IRR. So guys, tell me if PVCI is greater than PVCO, your NPV is greater than
0.
0. Your PI is greater than 1. And I will now add your IRR is greater than your cost of capital. Everyone. I've used KO as cost of capital. It means that you have earned more than what was required. Clear?
Yes.
And now see the connection. If I say PVCI is less than PVCO, your NPV is less than 0.
Yes.
Your PI is
Less than 1.
less than 1. And I will say you will earn less than your cost of capital. Clear, everyone? Does that change your decision?
Yes.
So if you're in the above case, if PVC is greater than PVCO, NP is greater than 0, PI is greater than 1, IRR is greater than KO, we will accept the project, isn't it? But in the other case, we will reject it, or else we will be indifferent. Indifferent scenario will be when PVCI equals to PVCO, you are at par basically, your NPV is equal to 0, your PI is equal to 1, sorry, it's automatically capturing the value. And I will say your IRR is equal to cost of capital. It means you have earned only to the amount which was required, not more than that. In such a case, we are indifferent between the projects. Clear, everyone? So what is IRR, guys? IRR is the discounting rate that makes the present value of the expected incremental after-tax cash inflows equal to the after-tax cash outflows. Basically, it is a point where PVCI equals to PVCO. It's a discounting rate which will make this present value of these all amount equal to 100. Got it? The minimum IRR that a firm needs to earn, how much is the minimum rate the firm needs to earn? Well, that should be equal to the cost of capital. If you make less than the cost of capital, then you're not even earning enough to pay back the capital providers. There's no point of running the project. You should not accept such projects. You should accept only those projects which makes money more than what you have to pay to the capital providers. Clear, everyone? So IRR has to be compared with the minimum rate or the hurdle rate. If you breach that, project should be taken. Clear? So at IRR, PVC equals to PVCO, therefore NPV equals to 0. If IRR is greater than required rate of return, the required rate of return is called as cost of capital, correct? Everyone?
Yes, sir.
If IRR is greater than required rate of return, accept the project, less than reject. And if you have multiple projects, which projects, and it's a mutual exclusive, you will select the project which has highest IRR. Clear? Everyone?
Yes.
Okay. Now, which all methods you have understood till now in terms of, evaluating a project?
NPV, IRR.
Payback period, discounted payback period. Correct?
NPV, yes.
NPV, PI, IRR. Right?
Yes.
Payback and discounted payback will help you understand which projects you should shortlist. The lowest one will be selected. Lower the payback and discounted payback, better it is. NPV and IRR, highest NPV, highest PI is the project we select. IRR, the higher the rate, the better it is. If IRR is greater than cost of capital, we will accept the project. But what if you have a scenario where the rankings become an issue? Now I want everyone to calculate the NPV and IRR of project A and B. How will you calculate NPV, guys? Put all the numbers. Discounting rate put as 10%, which means when you press NPV, you get pop-up of I in your calculator. Put 10 and let me know the NPV. Everyone. Put that into your calculator and let me know your NPV. Do not do any error. First clear CF, second clear. You will put -100 as CF0, 40 C01, 40 C02, 40 C03, and 50 C04. Discounting rate put 10. Okay. Let me know the answer that you get.
33.62.
Very good. 33.62. Correct. And then quickly press IRR. Press IRR and press compute. Press IRR and compute. You'll get IRR there. Just one step you have to do. Press IRR and press compute. 20?
4.22.
0.22, right? Correct. I'll write that in percentage. Very good. Let's do the same for project B. So for project B, you can do the same thing. So for project B, you have cash flow 0 as 100. The cash flow in year 1, 2, and 3 is nothing. So here you will put 0, enter 0. You can also change the frequency if you want. And in the last year, you have a cash flow of 200 altogether. So then I put N, compute. I get 36.60. Am I correct? 36.60.
Yes, sir.
And when I press IRR and compute, I get 18.9.
0.92.
So I will just input those things. I get the answer as 36.60, correct? We got. And IRR was how much? 18.92.
18.92.
Tell me one thing, based on NPV, which project will you select?
Project B.
Project B will you select or A based on NPV?
B.
Well, based on NPV, you would select project B because that's better, right? It gives you more value. But based on IRR, you may select project A.
Yes.
Because project A has more IRR. This is called conflict in rankings. What is this called as? Conflict in rankings. Now, what should you do when there is conflict in rankings? That's what we need to understand. But before that, let's understand what are the pros and cons of NPV and IRR. And after that, we can conclude which one is better. The biggest advantage of NPV is that it gives you the dollar amount, the actual increase in the shareholder value. So NPV is a direct measurement because it tells you the exact value that your shareholders will get as of today in present value terms. So it gives you the dollar amount. Got it? Now, first of all, if I give you, let's say, if I offer you a salary, if I offer you two types of salary, in one salary, there will be 50% growth rate every year. And in another salary, there will be 10% growth rate. Which one will you choose?
50%.
50% naturally. But in the 50% growth rate, I offer you 10,000 only per month. And in 10% growth rate, I offer you 100,000 per month. Which one will you prefer now?
100,000.
So the percentage makes no sense if the amount is big difference. First, you need higher value and then percentages matter, correct? So there are many people, they say that, last year my score was only 50 and now I've got 55. So I've done 10% better. Got it? So it's a lower base which helps you better. That percentage is illusionary many times. What is more important when you do a project is the amount, how much dollar increment the shareholders get. the company gets, how much increase in the shareholders' wealth or increase in the company's market cap is going to happen. Percentages won't matter. So if there is a project which is just going where you just have to put $10 million and you'll get 10%, but if there's a project where you have to invest $100 billion and you'll get 5%, you should rather go with that project if you have capital, because total dollar increment in your value is more important. So NPV is theoretically the best method, but the problem is that we just saw one of the problems because of which we had to rely on PI. What was the problem there? It does not consider the size of the project. Are you getting it? So here, if you see, both the projects are of different size, but if they both had the same NPV gives us, an improper answer. Got it? However, we can correct that by using
IRR.
PI, profitability index.
Sorry.
Clear? So that's the only drawback about NPV. However, the biggest drawback about IRR is that IRR is based on the concept of compounded returns. And if you remember from our first topic of discussion, time value, compounded returns, what is the biggest difference between simple and compounded returns, guys? The biggest difference?
Reinvestment.
The concept of reinvestment. So it assumes that you will do reinvestment at the same rate, correct? So when I see your IRR in this point, when you see IRR of, let's say, 18 or 24%, is it possible that you will be able to reinvest at such a high rate? Is it practically feasible?
No.
It's practically not feasible. Therefore, IRR is only theoretically correct. Practically, it is very, very improper. So, of course, the advantage of IRR is that it gives you the answer in percentage. So it will tell you whether you'll be able to cover the cost of capital or not. But the problem is that IRR is not practically feasible due to the reinvestment. Now, even if reinvestment is possible, let's say IRR is 5%, then reinvestment at 5% is possible. Still, after that, there are some problems. And that's what we are going to address. What are the problems? I want you to calculate NPV in this case. First of all, do you see the cash flows? What are the cash flows? Negative in the 0th year, then positive, and then again negative. Conventional or non-conventional?
Non-conventional.
Non-conventional cash flows, everyone, right? Now, at IRR, your NPV should be
1.
Zero.
Greater than 0.
NPV should be 0, correct? So guys, I want you to go to the cash flow function. Put CF0 as minus 1700. Let's go to the cash flow function. First, clear it. CF0 as 1700 negative. Then put C01 as 8500 positive. And put C02 as 10,200 negative and enter. Press NPV. It will ask you for discounting rate. How much discounting rate you will put? Just press 100 into it. Press 100 as the discounting rate. And then press down arrow and compute NPV. What do you get? The discounting rate you put 100, press down arrow, and then let me know what is the NPV that you get. Sorry?
0.
0. Right? So it tells me that the discounting rate is 100, right? But if you put the up arrow again, and in that I put 200 now, put 200 and enter, 200 and enter. And then put the down arrow and compute the NPV, you'll still get 0.
Yes.
Are you getting it?
Yes.
What is the problem? The problem with IRR is that when the cash flows are non-conventional, IRR gives you incorrect answer. You see here, IRR is giving you multiple answers. At 100 also it is 0 and 200 also is 0. Is it practically possible? It's a mathematical issue. So the first problem with IRR is that it gives you multiple IRR, especially when the cash flows are non-conventional. Are you getting my point? So in this case, what is the issue that they may ask me in exam? They may ask me that, what is the likely IRR? Well, I will say the IRR is 100 and 200 both. That is C. But which is incorrect, right? Why is it incorrect? Because there cannot be two rate of returns for the same cash flow, isn't it? That's the problem with IRR. It gives you multiple IRR when the cash flows are non-conventional. There's one more problem with IRR. Guys, just put this cash flows into your calculator. 370. I put inflow first, okay? Which is practically not possible, but still put CF0 as 370 positive, C01 as 1100 negative, and C02 as 925 positive, and then calculate IRR. Then calculate NPV, sorry, based on the discounting rate, or simply you can calculate the IRR directly. Forget the discounting rate and NPV, just calculate the IRR. Let me know what do you get.
Zero, sir.
Sorry,
Zero?
are you getting 0 or error?
Error, मतलब कुछ आ नहीं
Error. It's not 0, you are getting error. Basically,
7.
when you have unconventional cash flows, there is a possibility that you may get multiple IRR or no IRR. Are you getting my point? So there is a possibility you may get multiple IRR or no IRR. Therefore, whenever there is conflict of ranking between NPV and IRR, which is a better measure?
NPV.
NPV is a better measure. Are you getting me? Everyone? So whenever there is a conflict in decision, our decision will be based on NPV or IRR?
NPV.
It will be based on NPV. So here, if I have two projects A and B, even if the IRR of project A is better, I will choose project B because its NPV is higher. Got it, everyone? Clear?
Yes, sir.
Anyone, any questions? So what will you do when you get conflicting rankings? See, the main evaluation is in dollar amount is NPV, percentage is IRR. When you are getting conflicting answers, you will always choose the one with the higher dollar amount, that is NPV. Clear? So NPV is like the messiah of project evaluation. It does not, I don't say that it does not have a drawback, but it is considered the best of the technique in order to evaluate a project. And that's how people practically also do it. Clear?
Yes, sir.
Everyone. So conflict of rankings, what will we choose?
NPV.
We choose NPV. And based on NPV, we'll make our decisions. But in order to get the NPV, what do you do? Can you tell me the process, by the way, guys? You have the cash outflow and then you have the cash inflows. What do you do to all those cash inflows? You
Discounted.
discount them by the cost of capital, correct?
Yes.
What
sir.
if your cost of capital changes? Will your NPV will remain the same?
No. No.
Your NPV may change substantially and your decisions will also change, right? If the cost of capital changes.
Yes.
So there are these two projects, projects A and B. Both are for 4 years. can you find me incremental cash flows for both the projects? What is incremental cash flows? Incremental cash flows means the difference between both the projects. The net between both the projects. For example, let's say take here B minus A. If I take B minus A from year 0, 1, 2, 3, and 4, what is the net cash flows? Can you tell me? If I take B instead of A, what is the net difference between the cash flow in year 0?
0.
Yes, in year 0 it is 0.
Yes.
In year 1,
Minus 40.
in year 1 it is minus 40, correct? In year 1 it is minus 40. In year 2 it is minus 40. In
Year
year
3
3 also it's minus 40. But in year 4 it is going to be different. It is going to be 150. Clear?
plus 1.
So when I take incremental cash flows, whether you take B instead of A or A instead of B, whether you take B instead of A or A instead of B, what will you have? You will have three, for the first 3 years, you will say here you have 40, 40, 40, sorry. And in the last year you have
150.
150. But I'll just change the sign depending whichever you take. Either you can do this 3 negative and the last positive, or you can put the first 3 positive and the last one negative. It doesn't matter, depending on which one you select. Now, guys, can you go to the cash flow function again? Please go to the cash flow function. If you go to the cash flow function, what will you put in CF0? 0. Then C01 will be 40, C02 will be 40, C03 will be 40, and then you will put 150. So you can put negative 40 in all the first 3 ones and plus 150 in the last one, and then calculate the IRR. Let me know what answer you get. Very interesting thing we are trying to do. Anyone with answer?
11.58.
11.58. Are you getting this answer, Divesh? 11.58 as your IRR. CF0 is 0. C01, C02 and C03 will be 40 negative, and C04 you will put 150 positive, and then press IRR and compute. Clear, everyone? $11.58. What is this 11.58, guys? Very interesting thing. What is the scenario here? I've taken the project's cash flow for A and B, both for the next 4 years, and got NPV at different discounting rates. You can just plot it on an Excel or a spreadsheet and you will get an NPV. If I take the discounting rate 0, which means I take no time value of money, then 40, 40, 40 and 50. It is 70, 120 and 50. That is 170. And the second one, it is 200. So 200 minus cash outflow of 100, that is 100. So at 0 discounting rate, it is simply the total of all the cash inflows minus outflow. But as I increase the discounting rate, the NPV value will become lower and lower. What was the NPV for a project? What was the, by the way, IRR for project A?
24.22.
24.22. At IRR, what should be the NPV?
0.
0. 0, right? So see, when I took 24.22, the NPV for project A was 0. And when I increased the rate, it turned out to be negative. So for project B, when is it 0? At 18.92?
Yes.
That was the IRR for project B, isn't it? But here you got something 11.58. What happened at 11.58? Do you see anything?
Equal NPV.
Very interesting thing. What happened at 11.58? Everyone,
Equal NPV, sir.
you are indifferent between project A and B. Both have the same NPV. Now, before this 11.58, before this, which project will you select?
Project A.
The one which gives you higher NPV. Which is giving you higher NPV, guys? You
Project
select
A.
project B. And after 11.58, you will select which project? Just notice. Project A. So there is a rate at which both the projects, you are indifferent between both, choosing both the projects. That rate is called crossover point. What is crossover point? When you are analyzing NPV profiles at different discounting rates, there is one discounting rate where both the projects will give you same NPV. That is called crossover point.
Over points.
At crossover, why it is called crossover? Because after that your decisions will change. See here, the crossover point was 11.58. Let me put here exactly as, let's say it is 11.58. Before 11.58, which was better project? See, project B was better than A.
Yes.
And after 11.58, A is better than B. Are you getting it? So there is one point where both are same and they cross over. That is called crossover rate. Is that clear, everyone? So whenever you want to take a decision whether I should select A or B, it's just not NPV and IRR. You plot them at different cost of capital, at different discounting rates. Because at one discounting rate, project A may be better. At, let's say, if the banks increase the interest rate, then your cost of capital will change, and then your decisions will also change. So what may not be feasible now may be feasible if your cost of capital increases or decreases. Interesting, isn't it? And how to calculate the crossover rate? Just take the difference between both the projects, and then calculate IRR of that. That is called the crossover rate. So this IRR that I got is nothing but my crossover rate or crossover point. Clear, everyone? Interesting, isn't it, everyone?
Yes, sir.
So whenever you select two projects, of course, you will see NPV and IRR and you'll base your decision. But then you're basing your decision assuming that the cost of capital is constant. But you know that in real life, cost of capital is not going to be constant. So you are going to plot them at various scenarios of cost of capital, and then you will see where they cross over. So then based on your assumption of cost of capital, what is feasible right now may not be feasible later, or vice versa. So you'll see all this different scenario, and there is one point at which both the projects are indifferent. So let's say if the cost of capital is going to be 11.58, then both the projects are same for me. Otherwise, I will have to decide which projects to go for. That point where both the projects are indifferent for me based on NPV, that is called the crossover point, and that rate which gives me this point is called crossover rate.
Cost of capital.
Clear, everyone? Crossover point and crossover rate.
Yes, sir.
Still, we prefer NPV as the best. Why NPV is the best? Because NPV, the name is net present value. It gives additional value to your shareholders. So let's say a company like Larsen and Toubro or ABB or Siemens, these are engineering companies. If these companies announce a project, let's say they announce a project where the investment is $100 million, and they have a tendency of generating an NPV, let's say of at least 10%. So I can say at least NPV of $10 million. In present value, 10 million company's value should increase, isn't it?
Yes.
Therefore, most of the times when companies announce a project, their share prices jump suddenly. Why? Because of the NPV that is expected. So NPV has a direct connection with the share price. So the value of the company depends not only on the existing projects, but also on the present value of the future projects. So when a company announces projects, its value immediately increases if the company's NPV is expected to, generate positive NPV. And first of all, you can't just increase the price randomly. Just because the company has announced a project, the company should lack credibility also, which means that the company should have in the past given a lot of successful projects. So it depends on the certainty of your expected cash flows and company's historical track record of giving successful projects. After announcement, they being able to generate that much value, what they have probably predicted. So it depends on a lot of your track record. But as soon as the companies announce the projects, the company's share value should increase or decrease.
Increase.
It should increase. By what amount it should increase? Let's see that. So here the company ATC, the tower company, telecom company, has 10 million shares outstanding with market price of 15. So can you tell me what is the market value of the company? $15 for one share.
$50 million.
$150 million, correct? On 31st December 2020. On January 1st, 2020, when the company initiated a new project with an expected NPV of $30 million. So guys, if the expected NPV is $30 million, its market cap should increase or decrease?
Increase.
Increase by how much, guys? $30 million. Clear? Everyone? $30 million in total. And they have said that the company has 10 million shares. So can you tell me how much should be the increase in per share? 30 divided by 10. Can I say there should be increase in one share by $3?
Yes, sir.
Clear? So what questions they may ask companies market? They have asked what could be the least likely. Remember, CFA Institute is very smart and most of the students make mistake even if the questions are easy because they don't properly read it, whether it's least likely or most likely. The least likely is the most troublesome, by the way. What could be the least likely impact of initiating the new project? First, company's market cap is likely to increase 30 million. That is not least likely, that is most likely. The share price will increase by 3 and the share price will decrease by 3. Which one should I select?
Option C.
The C one.
E.
Correct? Because A and B are more realistic. The company's market cap will increase by $30 million and per share price will increase by $3. What will not happen is that its value will decrease. Clear? So whenever the companies announce projects, and if you know the NPV or if they have estimated the NPV divided by the number of shares, that should be immediate increase in the share price. However, as I said, the estimation of that NPV should be very much reliable. Clear? So quickly tell me, which are the techniques that you have understood to evaluate the projects? Payback and discounted payback?
NPV, IRR,
NPV,
PI.
IRR, PI?
PI.
And between NPV and IRR, which one will you choose if there is conflict?
NPV.
Very good, NPV. But you will also see various scenarios at which the project should be chosen, because at different cost of capital, your NPV will change and your decisions will also change between two projects. So along with NPV and IRR, you will also evaluate various scenarios. Basically, what am I trying to calculate?
Crossover points.
Crossover point, because crossover point will tell me at which point my decision between two projects is going to be same. Otherwise, my decision may drastically change. Clear? So finally, what people in the world do? Well, it is said that the Europeans generally prefer payback period instead of NPV and IRR. Very strange, isn't it? But they prefer payback period instead of NPV and IRR. Why? Because there are so many debt related issues in Europe, and that's the reason why they are more keen when will you pay back the principal. So they don't want to have the credit issue there. That's the reason why in Europe, you'll find payback period having more value than NPV and IRR. Okay. However, most of the firms, larger companies, make their capital budgeting decision in practical life also on NPV and IRR, and whenever there is conflict, they go for NPV. Clear? Who uses payback more? Private companies use payback period more frequently than public companies, because private companies are always, they find it very difficult to raise capital. So they are always in that, always on the edge to repay back the capital. So for them, the payback criteria is very, 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 very important compared to the public company. Public company find it very easy to raise capital compared to the private company, right? So private firms use payback more frequently than public firms. And because, people like you and me, we are going to be the MBAs and CFAs, and we have learned the technique of discounting cash flow, which we just saw. Because we've learned, and because you all have spent so much of money in doing CFA, definitely you want it to be a little bit tougher, and therefore we use mostly discounting cash flow techniques, whether for evaluating projects, whether for valuing stocks, whether for valuing bonds or real estate or any asset or any project or any investment decision. We as analysts, we always use discounting cash flow technique. We prefer that more. So MBAs and CFA chartered holders and all analysts, they rely more of DCF techniques. That is, they rely more on NPV. Clear? Everyone?
Yes, sir.
Well, that's the end of capital budgeting. One of the most interesting and easiest topic, right? Any doubts, anyone? Anyone, any doubts?
No, sir.
No?
No, sir.
Okay. Thank you so much. So we'll meet in the next section with another topic. Okay. Thank you so much. Take care. Bye-bye.
Have a good day, sir.
You too. Bye-bye.